Let's dive into it today. 3 rate cuts could be in order. We're going to break it down for you. My name is Paul Barron. Welcome back into the show. I do want to thank our sponsor today, and that is Gemini. You guys can jump over to Gemini.com/credit-card, and you can get this right here. That's the Bitcoin credit card, where you can earn Bitcoin back in as much as 4% right into your account. The other cool thing about this is when you sign up for this card, you can also switch the type of tokens and assets that you want to earn on. So whether you're XRP, Solana, it doesn't matter. All of this is available. This is a great card that really gets into a awesome bonus, and that is $200 in Bitcoin bonus when you go in and spend $3K in the first 90 days. So most likely you guys are spending that on groceries and all kinds of other expenses. You can get that back right there. And there's no annual fee on this card, so make sure and use our link down below. Here's the cool part right here, 4% back on gas, EV charging, transit taxes, basically all your transportation, 3% on dining. So right now is the time to get it. Use the link down below and you guys get started and start earning back in your own digital asset that you guys like. Let's go over into the key statements today, and of course that is the Fed is about to join the global rate cut cycle. There's been 88 rate cuts worldwide. Year to date, and this is the most since 2020. We haven't seen these kind of numbers since then. That's insane. 88 rate cuts everywhere else but here. This puts 2025 on track for the 3rd fastest global cutting cycle on record, and this, of course, is Bank of America kind of talking about this. Other things that are playing into this, if you think about what's going on in Canada, our neighbors, but also the ECB. This is where we're getting into 3 rate cuts already. We're going to see 4 rate cuts and 3 more times this year, most likely. I think all this plays into one thing, and that is the Fed getting ready to adjust everything. The odds, though, of a monster 50 basis point September rate cut have increased to 10%. This is the first time that's actually showed up. And remember, we're still, what are we, almost a week away, 10 days away of the FOMC meeting. I still anticipate we could see that 50 basis points up around 50% by the time FOMC comes just around the corner. And of course, here it is on Polymarket, zooming in right now. Polymarket holding 86% on the quarter, 10.3 on the 50. And of course, no change does not look like it's going to happen overall. But the fact that we've got 10.3%, that was around 6% a week ago. A week from now, if that goes to 15, 20%, it's really in the cards to where we could maybe see that. And that would be a bit of a surprise. Let me know down in the comments if you guys think we're at a quarter. Just put 2.5. Or are we getting a 50, put 50, down in the comments below. And if you're not subscribed to the channel, do that as well. I want to go over to one of the analysts on CNBC that gets into a breakdown here on the scope of the Fed and why it's been too narrow. Take a look.
What it thinks. I asked, by not cutting rates this year, the Fed is A, doing it right, or B, getting it wrong, Mohamed. 67% said the Fed is getting it wrong by not cutting rates sooner or more aggressively. Would you agree with that take?
I agree with the 2/3 who said that they have been getting it wrong. You know, there was a bunch of us outside and inside the Fed that were arguing for a July cut. And our concern, which is playing out in the data, is that Chair Powell had taken too narrow a view of the jobs market. And by that, he was ignoring the weakness that was starting to come to the surface.
Can they make, let's assume that you are correct, as you probably are. I would, by the way, agree with you. Can the Federal Reserve make up for a policy mistake of not cutting rates already by overcompensating on September 17th by cutting by 0.5%, not 0.25%? Would that sort of make up for any sins of the past?
We've seen this movie before. We saw it a year ago, where they refused to cut in July and they did a jumbo cut, 50 basis points in September. I think this time around, the risks to the economy are higher than they were a year ago, because we've eroded, as you just discussed earlier, we've eroded the financial security of lower income households. So could they catch up? Yes, they could. Hopefully they will, but it's a more risky operation than a lot of people expect it to be.
All right, so here's my point on this, guys. First of all, if you look at how many Fed rate cuts in 2026, right here, we got 250 basis points. That's 42%, 375. and then 1 quarter basis all the way down at 9. So basically what they're saying, between now and next May, when Chair Powell will be out, we could see as many as 5 cuts. So all of that is definitely in a corrective measure, but I would agree, July was when I was kind of on my stump box saying we got to cut in July, and I think we're already late. All of this blends into all the way last year. If you go back and look at some of my videos last year, my concern was jobs, and this was all around the last 50 basis points because of the thing that I talk to the most is CEOs of big companies that hire a lot of people and employ a lot of people, and they were telling me at that time last year, in the fall of 2024, this is a problem, Paul. We're starting to see less foot traffic in some of our retail locations. We're starting to see real impact. It is affecting the way we hire people. When that is said in one of the biggest employer categories out there, which is the restaurant industry, then I'm always taking note, and that has been the factor I've been talking about for over a year. I don't know that there is a way for them to fix this quickly, and I think that's what we are faced with right now is a corrective measure going forward. Here's another clip that's why is this a bad time to cut rates? Listen to what he had to say here.
Typically, the Fed is known to cut interest rates when the stock market's falling, credit spreads are widening, there's some financial market dislocation. This time, we got credit spreads close to record lows. The stock market's obviously very ebullient given the valuations. We have an AI mania building up as far as the market's concerned. And in this environment, for the Fed to be cutting interest rates would be pretty unprecedented. So I think that's the main perspective that I've tried to provide in this op-ed today. And in the past, when the Fed has cut interest rates, when the economy's been doing okay, it has usually been a recipe for a bubble. That's what happened in 99, 2000. And some will argue that that's what, possibly even happened in 2021. But I think the main issue here is the fact that financial conditions are super easy. The Fed has never cut interest rates when financial conditions have been this easy.
Yes, but I would argue that financial conditions are not its mandate. Yes, it's a transmission mechanism, but the mandate is stable inflation and maximum employment. And there's some worrisome signs on the jobs front, and so they want to get ahead of it and cut rates.
Yeah, but I think the Fed is overly focused on the labor market. Whereas I'm trying to sort of say that if you look at the whole picture, including the mandate that you speak about on inflation, the inflation rate is well above the target, and it's missed it for 5 years in a row.
All right, so I'm completely on the opposite side of what this analyst is pointing at. I think they kind of defended a little bit there on CNBC is that the jobs numbers are the indicator, and yes, the mandate is pretty clear, inflation and jobs. Not necessarily a worry of how the market, and I want to show something here because this is my theory of where we are in the market cycles. And if you go all the way back to the S&P 500, as you overlay this against what was one of the biggest pullbacks in American history, which was the dot-com bubble, that's this period right here. It was in 2000. That was the run-up that we had right there. Let me kind of zoom in on that to really get you guys close. Look at the difference between 1982, really if you pull it down to around 90, but the number really was in 1995 when we saw this, and I'll show you something in a moment. Look at the run-up we had right here going into that, 1995 to 2000, of which I was living and working in Silicon Valley at that time. I saw this literally on the sidelines right there in front of it, watching it happen and working for one of the biggest companies out there that was kind of flowing into that space. And I knew at that point we were going to see a major, major correction in the market. And of course, in 2000, that's when you had the pullback, and boom, that was our bottom right there in 09. Obviously, there was other reasons for that. When you go down to 2008, had we not seen that financial crisis occur, probably would not have seen this little trough right here, because this was a pullback mainly because of the housing problem that we dealt with savings and loans. So let's get away from that. I want to go over into where we are now. And here's the point. If you look all the way back into the last time we saw a major top like this, 2000, that's a quarter of a century ago. I want you to go back and look at 1/4 century prior to that. So between 2000 and 1975, look at the disparity between 1975 right here and where it was in 2000 in March, right there. That's what I'm getting at, guys. These markets do not stay the same. It doesn't really factor in that we're dealing with all-time highs. Yes, we are, but we were dealing with all-time highs all the way up from 1975 until 2000, a quarter of a century. So that's my point, is that we're dealing with right now. Now, some people would argue, well, Paul, you're also looking at that bottom in 2009. Maybe that's the quarter of a century. Yeah, there's a possibility, but it's still 25 years out from 2009. So look at that, and it would be more toward like the middle of 2030 to 35 as a pullback after a major market adjustment. So there's so many variables that play into this. If you believe in liquidity cycles, which I think is a real thing, and we are seeing that. If you believe in M2 supply, money supply, the amount of money that's sitting on the sidelines right now, which is the rich going to get richer because they have so much liquid capital available because of what happened in 2020. And now the separation between the two classes, which is really the haves and the have-nots. And that's the issue that I think we're facing right now, because I think the haves are going to be battling with the other haves for this next leg up. And that's what Tom Lee is talking about a lot. Before we get into all that, and also to what Tom Lee says, I want to remind you guys, the way you stay ahead of all this, I want you to subscribe to the Diamond Circle. And this is our own private email group. I go in there, I drop an email, usually every week, and it's the Bear Market Edge, and it basically kind of gives you alignment on this, gives you updates on what we're doing from a research standpoint. Just hit the link down below. You guys can become part of that. It's the Diamond Circle. You want to get in this one right here, which is the free one, and you're in, okay? Do that, and hopefully you guys can kind of jump into it. Now, I want to jump over to Tom Lee and what he was saying about jobs data, because this translates into where he thinks the market is going. Take a look.
Are you of the view 3 times this year, minimum?
If I look at what the bond market's pricing, which is now essentially 3 cuts, and the Fed is talking about 2, the bond market is saying the Fed is behind in terms of how they're perceiving these changing conditions. And so I think on the 17th, when the FOMC makes its rate decision, I think there is a chance the Fed responds to that. And if it does, it's going to be good news, because the bond market is going to take comfort from the Fed at recognizing the labor market's weakening.
Tom, you know, one of the things that Scott Bessent said was he thinks that the economy is actually in better shape than we think, and that the jobs numbers are going to get better. How does that factor into your thinking, or does it?
I mean, I think on the margin, I'd agree with Treasury Secretary Bessent's comments for 2 reasons. One, when we go through corporate earnings, we don't have any increase in comments from businesses saying business tapered off in July or August. So even though the labor market shows like it's deteriorated the last 2 months, business conditions haven't. In fact, even the Fed's beige book, most regions reported improving conditions. So that is one thing. And the second is, we know the labor market undergoes a lot of revisions, and we get September's benchmark revisions. I think it may show that the job market's been weak all year. And in fact, maybe the last few months have actually been stable. So I think Treasury Secretary Bessent is sort of correct to an extent.
Okay, when he puts it that way, because I disagree with this in the sense that, yes, I think the job problem has been a much more nagging injury for the economy, and it's just now, starting to show up. But it takes a long time for this to correct, and typically what you have to have for a job market to correct is cheap capital. And we don't have it. We don't have cheap capital right now, and until we see those rate cuts, you're not going to see businesses reinvesting into anything. And the big concern I have is, when cheap capital does come back around, will they reinvest into traditional labor, or will they start to invest into AI, robotics, all those kind of things, which is a concern, because I think 27 and 26 could be a major transformational era. Now, with that, it still pushes a lot of these digital assets to the next level. Now, Tom also came back and said, hey, I think Bitcoin might reposition some here. Listen to where he thinks Bitcoin is going to be by end of year. Take a look.
Hey, Tom, Bitcoin, before we let you go, tell us what you think. We're at about $111,000. The upside, the downside from here?
Bitcoin and cryptocurrencies like Ethereum are super sensitive to monetary policy. So I think that September 17th is an important catalyst. Crypto typically does really well in the fourth quarter. So I think Bitcoin can easily get to 200,000 before year end. I know it's a big move. It's almost a double. But that's also going to be a
double from here. Let's just hold on. Let's just take a quick pause. A double from here. So everybody's listening to this. We're at $111,000, and you think by Christmas time, effectively, we could be at 200,000?
That's right. One of the reasons Bitcoin stalled this year is the Fed's been on pause for 9 months. That pause all year, if you look at an easing cycle, that's only happened 2 other times, in 1998 and 2024, where the Fed began to resume cuts in the fourth quarter in September. Equities do really well. As you know, crypto is beta to equity. So I think it's going to be a very strong fourth quarter. Small caps should also rally, like IWM, but that also is really bullish for Ethereum, which is highly linked to small caps.
Other things you have to look at is the strategy that's been building around Ethereum. Tom Lee did something that was kind of surprising here. This is where BMNR did a moonshot investment, and what they put it into was a ticker called OCTO. Now, this company is going to initiate basically a WorldCoin treasury strategy. Now, in just a short period of time, this was a $20 million investment. In a short period of time, look at the stock difference right here. This is ACO, the company, OCTO, right there, ticker symbol, OCTO. This is the kind of growth that we've started to see up, and this would have made Tom Lee and that investment go on paper profits, up to around 550 to 600 million, basically on 20 million investment. So not a bad move by those moonshot investments. Now, does it hold or do you short it? That's kind of the other factor that size into this. You look, of course, Tom Lee built a $2 million ETH reserve, I should say, in less than 60 days at 10K ETH. This will be worth around 20 billion. This would place BMNR in the list of the top 400 largest public companies in the U.S. That is a massive, massive, imagine you are the former CEO of BMNR, and Tom Lee and a group of investors come to you and say, let's put it in Ethereum. And all of a sudden you go from a no-name, nothing stock to a top 400, and that's if ETH goes to 10K, which is just another doubling if it compares to what's going on with, of course, Bitcoin. Other things that play into this, Ethereum stablecoin supply hits a record. This is 165 billion in tokenized assets. This is all obviously because of the surge we're seeing right now. Supply reached a new record. And we also see tokenized gold and U.S. Treasuries on ETH also hitting all-time highs. This is another big factor we'll talk more about. Other facts that kind of play into this, which is interesting, this is a new all-time high that gives Ethereum a 57% share of the stablecoin market. And if we continue to see the growth in stablecoins, which we will, we're just going to see this continue to ramp up. And I think it's going to be multi-trillion. Many people were kind of pointing on that 3 to 5 trillion. I think it's well in excess of that in terms of exposure for stablecoins. And that only means good things for Ethereum in general. Other things I want to hit on right here, Sol Strategies just got their NASDAQ listing. And of course, this is a big one. It's going to be listing under STKE. What a great ticker for them. This is going to commence on Tuesday, tomorrow on the 9th. So get ready for that. CEO Leo Wald talked about this. Another big one. And of course, this means Sol Treasuries coming to the stock market. Again, this will probably grow. Let me know in the comments if you think the STKE will do better than BMNR or some of the ETH Treasury companies. Just put ETH or Sol down below. Let's get into this right here because Fidelity has now a digital interest token. This is basically the, think about this as kind of the BIDL. If you look at Securitize, they were doing the same thing. This is what Fidelity is doing now with their digital interest token. And in a very short period of time, bam, look at that. And this is just getting started. So imagine what this is going to do in a matter of just 3 or 4 months of what this is going to look at. And this is called FDIT, so you'll be able to find it over there in your Treasury or your app on Fidelity, so check it out. Let me know what you guys, if you're on Fidelity, let me know how you're experiencing that, because that's a closed ecosystem for both Bitcoin and ETH purchases, but also the money markets are being paid mostly quite a bit higher than a lot of these other platforms out there. So Fidelity kind of winning in that area. This goes back into this S&P thing that we were talking about earlier. And I want you to pay attention to something here on these all-time highs. I'm going to zoom in on this so you can kind of see. And this is the number of highs that happen in the year. All right, I want you to go back to 1995. Follow down the road with me to 1995, you know, when Prince had great music and David Bowie was still out there pumping them. 1995, 77 all-time highs. That's the big winner. Look at what happened in 96, 39, 45 in 1997, 1998, 47, and in 1999, 35. So between those 5 years, you absolutely killed the market. And then, of course, we all know what happened in 2000. That is the dot bomb when we saw $7 trillion come off the stock market in literally about 8 months. That's the kind of pullback that came. Now, many people would say, well, what about now? Well, if you throw out the 2020-21 era, which was fabricated market moves, and you go into where we are now, that should have been more like this right here, 19, 5, 8, 10, etc., all the way down to what we see. This was just mostly recovery and a more moderate. But now what we're dealing with is another 2024 and 2025, 21 highs, but definitely nothing like 1995 where we had 77 all-time highs. So maybe Tom Lee and these analysts are right. Think about that, guys. We could just be beginning where this market is going. Let me know what you guys think. One more thing I want to hit on. This is one last analyst that hits on this. The S&P 500 likely to peak at 9,914 in September of 2027. This comes from Bank of America's guy. His name is Michael Hartnett. He's also been known as Nostradamus of some of these calls. If that moves to that level, guys, the amount of GDP and growth in the United States, I don't even know how you could put numbers to this because of the amount of exposure we're getting into all sorts of new asset classes, including digital assets. But where will gold be? Where will now if we see an S&P at that rate, what will the GDP look like in the United States, and what is going to cause that to continue to drive? Well, if you think about this along with other countries that are trying to reposition around everything, the Japanese are in the middle of it right now because their prime minister has walked away from it, and he was one of the few guys that was, I won't say anti-digital assets, but definitely not pro-digital assets. And now what we've got is a whole new potential front runner leading in to the Japanese. And this market is very important, guys, because it has such a major impact on not only U.S. Treasuries, but the global financial markets in general. So Japan might be in the middle of a major shift around their prime minister, and it could be one that is very forward thinking into digital assets. So pay attention. A lot happening right now in the markets. Make sure and subscribe to the channel if you're not already. Get in the Diamond Circle, very easy. Follow me out there on X, @Paul Barron. We'll catch you next time right here on The Paul Barron Show.